from the heart of Dubai, where tomorrow is being built today, to the world. Welcome to the CTO Show with Mehmet. Here, we redefine technology and reimagine possibilities. With Mehmet, delve into the riveting realms of AI, cybersecurity, and digital technology. Experience the thrilling highs and lows of startups. Immerse yourself in the spirit of entrepreneurship and witness the future of business innovation being written in real time. Now, without further ado, let's tune in and explore the future.
Hello and welcome back to a new episode of the CTO Show with Mehmet. Today, I'm very pleased, joining me from Boston in the US, Adrian Mendoza. Adrian, the way I love to do it is I keep it to my guests to introduce themselves. But disclaimer here, Adrian have a very interesting background, which made me very, very excited. Adrian, I will leave the floor to you. Just tell us a little bit more about you and what you are currently up to, and then we're going to take the discussion from there. So the floor is yours.
Thank you for having me on. I am Adrian Mendoza. I'm the general partner. I'm a AI FinTech cybersecurity investor. The interesting thing about me that made me attractive to reach out to Mehmet in the first place was I actually was a tech founder before this, and I actually had two startups. And in those roles, I was the CTO. So I've gone from founder to CTO to now investor. So I'm pretty familiar with the journey of both. And so we are a venture fund based here in the US. We've now raising a $100 million fund. Primarily, we invest in early tech founders that are innovating, modernizing, and looking to transform areas like financial services, insurance, manufacturing. And in those, we've invested in companies that are FinTech, AI, infrastructure, cybersecurity companies. My background was the tech founder that, had done work for some of the larger brands. And when we were walking around and saying, all right, what role are you going to be? I happen to be the most technical of all the founders, and I still play that role here in-house. I know a lot of the technology platforms, and so I'll definitely have a very much opinion today on what I think a startup CTO is and isn't.
That's fantastic. We have a lot to uncover with you today, Adrian. Now, the first question, which might be like kind of, we expected this question, but what attracted you to shift gears from being a tech founder to go the other side of the table and becoming in the world of the VCs?
After we sold our companies, our story is we had one company, it pivoted to a second company, and then the board said, hey, we want to sell this and go find something to do. And it was like, well, you don't have to tell me twice. But kind of our experience is we had some engaged investors and some not so engaged investors. And afterwards, I would meet people that said, hey, I know you, I invested in one of your companies. And I was like, who are you? And they was like, oh, I went through this fund or I went through that angel group. And I realized that there was just this incredible talent that was sitting on the sidelines, that if we had an opportunity to connect them to founders, you could create something really amazing. And that's always been what we built at Mendoza Ventures. We say we're by founders for founders because we run and operated several companies before. My partner was our COO. And so for us, it was, how do we look at taking the operational experience, knowing some certain spaces, the domain experience. And for us, we started 8 years ago, and that's been some key to our success, is knowing their journey, but at the same time, knowing prior to having the startup, I bootstrapped the company building some of the first mobile apps for some of the banks. So I knew how to go through risk, compliance, infrastructure. And so that's really has helped us with our founders because we've done it before. We've actually been in their shoes. We've deployed to those clients that they are trying to get into as well.
I'm pretty sure, Adrian, if this was a live streaming, I can imagine the amount of questions that would be coming, especially because I was telling you before we started the recording. So last year, I spent probably like 90% of my time just trying to understand the struggles of the founders. And of course, there were like two things that used to come again and again. The first thing, of course, is like, okay, we've come up with this product. We think we are up to something. We need some help in getting it out to the market, right? Of course, but the one which was always coming more is how we can find a fund, right? So we need to get money so we can build this thing. Now, is coming from a founder background makes this interaction with the founders easier? Can you like sense from them this empathy? Because I would tell you, like, one of the feedback that I always come and the people who comes to me, they tell me is, Mehmet, like we presented, but these guys, they kind of ghosted us. Like these guys, they're asking us questions nonsense. Now, I'm curious to know, and maybe this is a strange question, I'm curious to know what you hear from the founders, when they know that you were in their place one day. So how this, relationship goes, even if you don't invest with this company, like, and I'm asking you this question, Adrian, because I like to put the human aspect on it before, of course, the investment and the technology and all this. I want to hear from you, like what you are hearing, challenges from the founders in that space.
Yeah, I think it's always raising money. But you also have to understand, like, funds are raising money at the same time. We raise money from limited partners to go into venture funds that then go into startups. And so everyone's always raising money. And part of one of the things that I think a lot of founders forget is that raising money is just like selling. It's like creating a go-to-market strategy. It's finding the right team, but also finding the right investors that match up to you. Because a lot of where I see founders go wrong, I think, are two things. One, they go out and they pitch everything and everyone, but they're pitching to people that will never write them a check because they don't invest in this space. They don't invest in that vertical. They do B2C, they don't do B2B, they do B2B, they don't do B2C. And so you have to treat it like a sales pipeline. And it's hard because when you're dealing with technical founders that are like, they may not be in that selling stage, but then you have to talk to them about, like, no, you're always selling. Though you're building product, it's not about building product. Part of it is, but also you're having to sell product and you're also having to sell yourselves and the idea. And then the second part, and this is where the empathy, I'm known to be very direct with founders. I actually was just in Mexico City. We had a founder with us and I was really direct with him because I was seeing him pitch and it was like, let me give you some pointers because you're running around talking to people, but you just have to be direct to them. Because if people know and that was actually very much our case. Like, we were warned very much, like, you can have conversations, but if people know you're raising money, you're raising money. And you have to, and one of the things founders forget is us as investors all talk to each other. Like, all of the AI funds, all of the FinTech funds, like, I know if a company pitches me, I know they've already pitched everybody else. And so we all talk to each other. And that's one of the things founders forget.
Right. So now I'm happy because you started to explain the other part of the story, which is, as VCs, you have to yourself go raise money from LPs. Now, let's for once and for all, as we say, Adrian, let's demystify this to founders so they understand actually, why things happen. So I want, to go, and I'm going to keep the screen this way because it's going to be like kind of Q&A very quickly on this part. Yes. So VCs themselves, yes, they might be coming from a bank, so exited founders like yourself, right? So they might be bankers, they might be in different places, and they are in a place where they can invest money. But let's put it clear that the VC, the GPs, the general partners, as we call them, they are not themselves putting that money. So can we explain this, Adrian, like more into details, where this money comes from and how, the decisions to invest happen within the VCs?
Yeah. I think if you're an early stage founder, you're going to raise money from three different types of people. There's the venture funds, and I'll talk about that last. There are these angels, people that have had an exit, and then they're just investing out of their own pocket. They're kind of some of the easiest people, because if they were a technical founder and you're like a very product focused, they might be enamored by you and say, all right, hey, I'll write, 50 to 150K. And then, or they, a super angel may write up to 250, but they're, sort of the easiest to raise money. Then you have these family offices that may be a family that had a business, exited, and now they as a family are writing checks, and they could be a range from 250 up to like maybe $1 million. And then you have venture funds. And venture funds are what's referred to as a blind pool. That means somebody creates a vehicle and then goes and fills that vehicle with investors, other individuals. It may be, in our case, we have a fund for banks. We have some of the largest institutions in the US as investors. We have family offices that don't want to do direct deals, but want us to do them for them. And then we have a small fund for individuals. And these are everything from CTOs to CIOs to CEOs that want to try their hand in investing, but don't want to go do it like them personally. They want someone else. And that's the role of the general partner. The general partner takes a partnership, which are the LPs, the limited partners, and you represent them in finding companies, due diligencing companies, and investing companies. So one of the things founders forget is that they go and pitch a general partner, and they think that person is like an angel investor. Oh, that person will say yes. No, the angel investors will say yes. For us, there is a process involved. Every fund has an investment committee, which is a group from everywhere from 2 to 10 or 12 people that all look at the investment and the due diligence. And then they look at markers or things they want or things they don't want in order to make that decision. And so one of the things I always recommend to founders are about 3 important things. The first one is to back channel the VCs. Like, what do their investments look like? Have they invested? If you are a SaaS company or if you're in a manufacturing company, look at what their investments are. So that's the first one, is just because if you are not in something that they've invested in, the high likelihood that they won't invest in your vertical will be very, very likely. So don't get timed up. Second one is do research on where they are in the funding cycle. Like, have they deployed a fund? Because I remember my experience, we went and we met a VC and we had about 3 meetings with him, and he was like, oh, I really like you guys. And we really liked him. And a friend of mine comes up to me and goes, hey, why are you talking to that guy? I was like, wow, we've had 3 meetings. He doesn't have any money. He just deployed his last fund. He still has to go and raise a fund. So you're just having conversations to have conversations, but he's never going to write you a check. And he never did, because he didn't want fun. And the third one is it should always be a back and forth. I appreciate it. And I always coach founders to say, not just like go and try to pitch their heart out, but to ask questions. And these questions will be like, how much do you typically rate? Like, how much do you typically rate? What does your investment process look like? How long does it take from like a yes to a check? And that's super important, because even in our case, we got a term sheet for an investment round in January. The round didn't close, or we didn't get money in the bank till December of that year.
Wow.
Yeah, because we were like, yay, we found the VC. And he was like, oh, I'm only going to do part of it. You guys have to go and raise the rest. And so then we have to go back to everybody, the family offices, the angels, the other funds. And that process, which started in January, usually here in the US, and it actually happens in Europe too, nothing happens over the summer. So now you have, a couple, from January till May, maybe a little June, July, August, nothing happens because people are on vacation, and anything you're doing is you're lining up meetings for January. And then you have January, October, November, and in the US, nothing happens between Thanksgiving Day and Christmas. So there are limited windows in order to raise money. And that's why it took till December.
Now, one question, Adrian, out of of course, not curiosity, I would say, but I imagine people would ask this question because you just mentioned it. When to go to an angel investor and when to go to a VC? Because I think there's a little bit confusion because I'm not sure if is it because of the VCs or is it because the founders, they lack the knowledge? Because we see VCs and, we're talking about this before we start, say, okay, we are early stage investors and the word early stage investors might be, explained in different ways. So early stage can be a company that have built an MVP, but still they didn't sell yet. Or an early stage company might be a company, they've built an MVP and they just have kind of few beta users running now, and they have good feedback from them. Now, the thing that I see from the founder's perspective, so they say, hey, we are a pre-seed company, we didn't build anything, and they go to a VC, and then they said, oh, the VC told us, hey guys, go build that and then come back to me because I only invest in something that is built already. And sometimes they say, hey, you don't have enough traction and so on. So what I'm trying to do with you, Adrian, is to minimize, I'll say, but it's going to happen, guys, because Adrian, you mentioned something really true. Pitching is selling, right? So you are selling and you do it as a founder, VCs, they do it to their LPs, and you're going to have rejections. But let's say we want to avoid these hard feelings. So when when they when they go to angels and when they go to VCs.
Okay. So it's funny because like selling, there's a process of qualifying your leads. And it's funny because founders forget this. Like, not everyone is a customer. Not everyone is an investor. And I always push back on them. So perfect example. Last week, that founder was over. He met with one of my investors who had invited them. And they had a list of all the names of all the people that they had talked about. They had spent hours putting names of funds and angel investors. And I walked in back of the house and I just took a marker and was like, no. And I crossed away 90% of the list. And they were like, I was like, that guy doesn't have money. That guy doesn't have a fund, blah, 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 blah. Instantly qualified the list. And that's the thing about it is the frustration comes from founders who are just pitching over and over and over and over again and not getting any traction. And what ends up happening is like part of your qualification is as you're learning about a fund or even an angel investor, and they all say they do early stage. Oh, everyone does early stage, but they all mean a different thing. And so you as founder have to do the work that ask, what does early stage mean to you? And then when you have early stage, they'll be like, well, there's people that like the idea phase, but they don't really. They like to make sure there's actually a product. There's like that traction. Well, what does that traction look like? Quantify me to X number of dollars, number of customers. And one of the things that I see founders struggle with, it's this VC thing that says, go find me a shiny rock. And where VC says, go do something. So they go out and do it. And then they come back and they're like, well, you should get me a red rock. And you come back with a red rock. Well, I really like more of a crimson colored rock. And so now you come back and now you're just doing that. You're not building the business. You're just chasing after this investor versus, one of the things that what I did is when I, and it's hard but this is why being an entrepreneur is hard. Like you should have some dollars set aside, but it's also on you as a founder to be creative. Like one of the things that I did when we were pitching our startup is we waited to pitch. We waited till we had a beta product and I had a referenceable customer who wasn't even paid. He just was a reference to tell them would I buy it when they build it? Like what would the price be? And like more of like a customer reference. The closer you get to having a product with a customer, the closer and better terms you're going to get on the money. But also, you also have to think about that these early stage funds may only write you a 50 to 100K check versus there may be a super angel that could write you 250,000. So it's like you can run after these funds, but you may not raise a lot of money versus you can go to 4 super angels and they could say, well, Mehmet, I love you. You're great. And then like write a $250,000 check. But it really comes down to the founder as just creating that pipeline for themselves and doing the research on who they're talking to.
Absolutely. Like this is very important. And this is the number one they teach people when they go into sales. But I think should be taught to anyone in any domain, because again, like I always tell people, if you are planning a trip, right? So the first thing you do, you plan your trip, right? So you say, I'm going to go first first you're going to search your destination. Where are you going? And then you're going to go and search the routes, right? So which routes would be the best option for me? What iterates me nowadays, Adrian, I'm not sure if you're going to be agreeing with me or no. So I see the people that they call them, I don't want to call them connectors. Like you find the name, these things that appears on social media, mainly LinkedIn and so on and so forth. And where, okay, I have a list of 10,000 angel investor in, I don't know where.
I know those. We get pitched by those. I probably get 20 emails from those a day. Oh, I have this company. The truth being, I ignore them, because if the founder can't find me directly, like it's not that hard to find like FinTech funds, we show up. AI funds, we show up. And the best way to find a VC is not through one of these connector things, because these guys are charging startups like 5-10% for raising capital. And that capital is expensive, because now I'm going to write you $1 million check, but you're going to write $100,000 to this person. Like that's not going to be attractive for me. So when I see those, I literally just delete the emails. The founders that really, really want to raise money will reach out to me and we got a lot of inbound, whether it be LinkedIn, whether it be Twitter, or we have founders dropping their decks off on front of my door. I was actually on a trip I was literally just arriving to London, and I wasn't even 15 minutes in. I was literally just leaving the plane, and a founder chased after me with his business card and walked with me from the plane to the border control, even though he had a flight to Munich. And he pitched me all the way down. I'm like, man, I'm like, you know what? A week later, he had a meeting in the office, because I appreciated that. Like his tenacity, but also he knew who I was. He knew what we invested in. He wanted to talk. He knew that we would come in on companies that had $1 million in revenue. And he started the conversation of, we're already at $1 million in revenue. Great. Now I'm all right, perfect. That qualifies you for me. And so even when you're doing inbound by LinkedIn, like tailoring the conversation, because even the inbound we get, a lot of it is, I'm looking for money. Like, blah, blah. There wasn't hey, I know that you invested in a company like this. Tailoring it to the fund you want to talk to will better to get you a meeting than not. And also finding a connection that you have, whether it be another founder. Other founders don't realize the power of another founder, of someone in your network that knows us, to say, oh, I know them. The majority of meetings we take come from founders that we may know that say, I know this founder and I really like, or another investor that says, oh, I like this person, and you should meet them.
Absolutely. Just one thing also, Adrian, and correct me if I'm wrong, but people, they think, oh, these guys, they are holding the money, they're not really serious. But the fact is that actually you have to deploy whatever you raise from your LPs. You have a, your time start to tick, right? So from the moment you close your funds until you deploy it. So you have, because let's say, I'm just giving an example. So
I'm going to correct you. It's not till when you close your fund. It's when you open the fund.
Exactly.
So let's say you do a first close on your fund and it takes you 2 years to do a final close.
Right.
You have an investment period that literally starts ticking. So if you know that someone just opened their fund, they have 2 to 4 years where they have to deploy the money. It's called the investment period.
Right. So this is why, I tell people, like, don't think that these guys, they don't want to meet you. So that means, as to your point, Adrian, so probably you are not fitting with their, area of what we call it thesis, right? So you are not fitting with their thesis, because these guys, they, for example, they invest only to, you mentioned at the beginning, in B2C only, and you are a B2B SaaS company. And of course, they would not look at you, because this is what they are focusing on.
Yeah.
Because again, and I'm just saying this to clarify to the founders, the same way you pitch to the VCs goes and pitch to the LPs, and they say, hey, we gonna invest in this, right? And then, of course, maybe, and then let me ask you this, Adrian. So you did your first fund, but you're gonna go and build your second fund as soon as possible. Have you changed, the area or the focus of your fund after you closed the first one?
We're on our third fund, and our first one was in 2016.
Mm-hmm.
And we were operators, and this is like unheard of. There was no founders that were doing funds. And so what we did is we said, okay, we know we want to do early. And we did what every founder does. We ended up talking to everybody. And we ended up looking at everything: doggy dating apps, insurance. Like, we just saw everything. And a year of looking at like 100 companies, we took a step back and we're like, okay, we're not going to invest in everything. Let's look at areas we know really, really well. Well, I bootstrapped my founder as a founder doing things for the banks. Well, let's look at FinTech at that point. That was Brit. It wasn't even called FinTech yet. Well, we built some AI. So we're going to we built some cybersecurity. And so then we said, all right, we're going to invest in these 3 spaces, and we're going to choose a company from each. And so that's how we did our first 3 investments. And then we ended up selling one really fast. The first other one was actually really a great story. It was a company called Alice here in Boston, and it's an AI gifting platform. And how I met the founder is, we just started in January 2016. I went to an event. They were having a pitch competition, and this guy just came and sat down with me. And we just started having a great conversation. And he said, oh, I'm pitching tonight. I said, oh, I'd love to learn more. And he started telling me about it. And I was like, I left that. I didn't even stay for the pitch competition because I was like too noisy. And I walked out thinking, I like that guy. I wish I could invest in a guy like that. And wouldn't you know, in May, he reached out to me. I'm not like instantly. In May, he reached out to me and was like, hey, Adrian, I've never raised money before. Can I buy you a cup of coffee to learn? And we sat down for a couple of hours. We talked about what it would take, and we ended up investing in him. And he was, his name is Greg Siegel. And every time we would do something, he would always ask for advice. And I always appreciated that. And one day he was like, okay, we raised like our first round, like what happens next? And I remember sitting down with him over lunch, and I kind of walked through where it would go and said, we're going to get to an A round, and then at a B round, more than likely you're going to get replaced because you've never raised a company with 100 something employees. And wouldn't you know, he got to a B round and he got replaced. And he was like, wow, I can't believe that happened. And one of the other founders said, well, Adrian told you this was going to happen. Like, he told you the future. And I actually have founders that have said everything Adrian said would happen, keep true. Because I literally early on after I invested, I was like, here's where the movie's going to go. And that, we have this saying that I always tell everyone: if you ask for, money, you get advice. If you ask for advice, you get money. And that was a perfect thing of asking for advice and like listening, but also not being like, oh, I'm going to do. I literally was like, let's talk to everyone. Let's get multiple term sheets. Like, we were like, it was a really engaged process to the point when he was raising a Series B from some pretty well-known investors. He was coming back to me for advice on a Series B. And I was like, hey, I'm not a Series B investor. And he's like, yeah, but you still take all my meetings.
Right. One of the things, because you were founders, Adrian, I'm sure like you can relate, but I would not ask you about the mistakes that the founders do, but I would ask you what would be a red flag for you. Let's say they pass the initial filtering, of course. So they reach out to you or one of your team members. So you decide, okay, it's worth to talk to these guys. But then once they start, what are like some of the red flags for you that say, you know what? No, 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 no. These guys, no brainer, no investment. What would be some of these red flags?
Yeah, I think I would say there's a couple of them. The first one is like showing up and everyone has a role. And everyone's like, I'm the CEO, I'm the CTO, I'm the chief revenue officer. And early on, titles are meaningless. Even if you were to go and hire like this highly experienced sales professional, you don't have a product yet. Like until like everyone thinks, and I think this is the thing with founders, they don't realize is that this is an organic process. Like the company you are when you just start is not the company you are at a seed round. It is not the company you are at an A round. It is not the company you are at the B round. All you can do is start putting the things in place in order to help you grow. And it's, early on, like there at my company, there were no titles because it was like everybody did everything. Everybody sold. Everybody helped build things. Everybody helped find customers. And then once we got that first round of financing, then we were like, well, somebody has to be the CEO. So I actually hired a guy to be the CEO. And then one guy was like, well, I really want to focus on sales. So he became our VP of sales. And then I was the most technical person. And then they were looking at me and they're like, well, I guess you're the CTO. And I'm like, well, I guess so. And I used to call myself the accidental CTO. And part of it is, but as we scaled, we were like, all right, let's build out an engineering team. And I should be replaced. Funny enough, I never got replaced. But like that flexibility of where you are is really important. And then it comes to the second point. The second point is sometimes founders have a very specific vision of what they want their company and their product to be. And I remember talking to a company a couple of years ago where I asked a question, said, hey, if someone bought you early, what would you think about that? And they were like, no, we're going to IPO. That company's never IPO. They, have not even raised a B round yet. And part of it is they need, the best advice I have for that about flexibility is every founder wants to say who they are. It's not who they are. It's who your customer says you are. Your first customer will tell you who you are, what product you are, what vertical you are. And that's the thing about it. And we look at the flexibility. And so that's why when you look at a company, you want to make sure that they have customers, because I'm going to go talk to the customers and I'm going to say, like, who are they? Why did you write them a check? Would you buy from them again? Because what you're trying to assess out is it an outlier that they got a customer, or is it repeatable? Because that's the piece of it. Is it repeatable? Because if they're not, and they just managed to get to 500K or $1 million, but they won't get there again, then that's something that's a warning flag that not everyone's going to buy. And so people always ask me, like, what's the one thing that you look at that will automatically like be like a good indicator of success? And I always say it's revenue. The more repeatable revenue you have, that aren't like 5K checks, 10K checks, but are, 50, 100, especially on the B2B side or on the B2C side. If you've got 10,000 to 20,000, 40,000 customers, most like early stage fintechs won't break 5,000 customers. You could find 5,000 customers in your state. You could buy them, just by like buying ads, but like the repeatability of it is something that's really important.
Absolutely. Now, you mentioned something about the route to exit, Adrian, and Do you think really founders, especially first-time founders, and I'm asking this on purpose, they are prepared mentally at least to accept that one day this company gonna be sold out? Like, because you mentioned, yeah, everyone has in his mind or her mind the IPO, but why they should actually embrace, no, you know what? Probably I'm gonna be bought after maybe my Series A, Series B, I would say. I'm gonna exit because I'm gonna be a serial entrepreneur and go start the next big thing. So why do you think still some first time founders they have this eagerness, which I can understand, for going IPO and going this big exits?
It's what my partner calls the Cinderella boy story. You're going to raise money and then poof, you're going to IPO. And it never happens like that. The path to success is a really, really windy road. And one of the things that I have to remind founders is your typical IPO is 17 and a half years. From seed to the IPO, it is a long time to get there. And during that process, you may not be at the company. I always said that for me, like I really did well at the early stages, like C to A. That was where I play, you get me managing 100 people, I would get bored. But like that, and the same thing with founders is you have to be like, where does that founder live in the life cycle of the company? And for a lot of them, like, it's not going to be managing a 100, 200, 30, raising $200 million. It's going to be like, all right, an early stage founder is great for that moment as early stage investors, as early stage advisors. But I think that's the path of the finder. And look, I've met founders who sell earlier than they're supposed to because they're like, this is too stressful. This is not the life I want. But there's some that will be like, I don't mind, because everyone forgets that even if you sell, you're going to still be part of the company. You just will not have any more upside that goes from there. But I think it's also like one of the things, it's like when I talk to, let's say, like AI companies, people are like, well, great. When's the last AI company that IPO'd? And they're like, yeah, there's never been an AI company that IPO'd. Then why do you think you're going to IPO? Mm-hmm. Like, you're more than likely 90% of the time going to get acquired, as in FinTech, as in cybersecurity.
Absolutely. Now, on the point you mentioned, you were accidental CTO, right? Now, how this makes the life easy for you and the founders when the discussions start, right? So, because you come from a technical background, so I believe even some, not all, but I mean, at least the preliminary stuff that happens with the technical due diligence. So maybe you can spot few things from your side, Adrian, right? So how does accidental CTO, background that you have, which I think you are a CTO, right? After all. So how this makes, the discussion and the technical due diligence and the whole due diligence later easier for you when to pick, a startup to invest with?
It's funny because people used to ask me like what my job was as a CTO. And I told them that my job was unblocking people. At the height of it, like we were writing code 24/7. We had teams in India, a team in Croatia, a team in like South America. And then we'd all meet up at like 10 o'clock and then review code. And so my job as CTO, and this is leading up to what I see as an investor, is I never wrote a line of code when we were up and running. My job was to make sure that my team was unblocked so that they could write the lines of code. And that I would sit in the meetings to make sure that I can get budget or that I can talk to the customers. And so my engagement was really high because I was the filter between the engineering team, the business team, and the customer. So in sales cycles, I would be brought in with the head of the sales guy to help close business. And he would be like, oh, that CTO thinks it could be done in a minute. And then I would be like, look, here's how we can deploy our code in a minute. I even did it on a video. And then I would send them a video ahead of time, and the customers were like, yeah, he's right. you could deploy that code in a minute. We don't even have to talk to them. And so when I start talking to the technical co-founder, the CTO, I don't really care about the code base. The code base, I can sick an engineer to look at it. What I really care is like, how do they think from an architectural level? Like I remember sitting and hiring a VP of engineering, and on a board, I said, here's what I want. And I literally like in a flowchart, looked at where I wanted our load balancers, where what would be at AWS, architected out everything. And then the CTO came by and he said, oh, did you do this? And the VP of engineering looked at me and said, no, he did it. And this is exactly what we're going to build. But that idea of taking the architectural, the big picture, and because one of the things that is when you're building an early product, you cut a lot of corners. It's what, the term technical debt comes from. And it's things that you're like, oh, that's a future Adrian problem. That's a future CTO problem. Well, one way or another, you're going to end up paying for it. And so what ends up happening is you cut a lot of corners, but then it's not like you can really take the time to rebuild things because now you have customers, now you have scale, and now little problems become big problems. And so what I want to suss out when we're looking at a technology company is where have they cut the corners and where are they breaking at the seams? Because at a certain point, I've seen really good companies try to get to scale and fail because the product just won't scale, even though the customers are scaling, but the product failed. And like in our case, like our first product was written on Ruby on Rails and would not scale at all. And then we ended up having to like just rewrite everything at the same time that we had customers, at the same time we were doing stuff. And we ended up changing our engineering team halfway through because some of them were good and some of them weren't. And so when you're looking at due diligence, you're looking at like what their view is, like from an architectural level, from a cost level, like, is this something where you need 100 engineers? Is this something where you maintain? Because the ideal purpose when you take a step back is as revenue goes up, your operation expenses, OpEx, should remain flat. If you have to go and as revenue is going up, your operation expenses are going up because you're hiring more engineers, you're having to pay more AWS, you're having to pay more software, then you're never going to get to profitability because your just margins are always continue to be the same. And so that's kind of what we need to push at because the bodies are the biggest expense, but they're also your biggest asset. And so for me, when you talk to the technical founder, again, doesn't matter about the writing code. What matters are, can they hire a team behind them? Can they hire the right people to work for you regardless? Like I used to have this example. We had an incredible VP of engineering, and I hired him. I fired him. I hired him. I fired him. I hired him again, and then I fired him again because we were just raising money, not raising money, raising money, not raising money. And right now, if I called him, he'd be like, "Great, where do you want me to be?" And that's the thing.
It's like a roller coaster.
It's a roller coaster, but at the same time, I once had a CTO that I knew. He had just sold his company and he was starting his next company. And he went to the VCs and the VCs asked him a question that I still love today and that I still use. The VC asked the CTO, hey, so you sold your other company? And he's like, yeah. What happened to all of your guys? Where are they? And that was a really good question. And in his case, his answer was, yeah, I had these 20, 30 guys, and these guys over here, I helped them find a job over here. And these guys over here, they're going to come with me on my next company. And these guys, they were good, but I'm okay letting them go. Especially for a good CTO, especially if you're a technology company, you need to have in tow, because hiring the right talent is difficult, regardless of whether you're sales. And I would ask the same question on a sales team. I would ask the same question on any of the other teams, the startup. But engineering talent is still hard, especially talent that you could trust.
Absolutely. Now, Adrian, I know, and you just mentioned which domains you focus on. So you said AI, fintech, and cybersecurity, right? Now, I just want to go one by one very quickly, but let's start with AI because it's where I think where we're gonna stop the most. Now, AI, right? So everyone is now talking about AI, and there is this, sometimes I read these articles saying like, yeah, these founders, even they have, this very simple AI application, but still they got, huge uh, investments from these VCs, while these guys who are building something which is, like hard to build, like it took them more resources to build, no one is looking at them. Is AI currently overrated? This is my first
Oh,
question.
I was on CNBC last year. I'm like, we're in an AI bubble again because now everything is AI. And it's like I think you'll anyone who sees any on a podcast, I'll talk about the pizza deck. I saw a deck from a group of technical founders that were using computer vision and algorithms to detect how many pepperonis were on a pizza. And where reality is like nobody cares. There's like a pepperoni is like what, 0.25%. Like who cares? And that's the thing about it is, and this is where, especially on the AI companies, where people fall in the trap of, oh, I'm going to build something. And it's like, all right, you're going to build something, but the people that are earning, that are raising the money now are the ones that could do a good job of explainability of the AI, but also the use cases people are buying, use cases on the vision for what it's going to go. And so this is kind of the curse of the technical founder, where they go in a hole and they start building something and they're like, but why aren't the VCs buying it? Why aren't the customers buying it? Because they're not able to tell anyone why anyone should be using this, why anyone should be buying it. And is it something defensible? Because if you're just building an application on top of an LLM like ChatGPT, there's nothing defensible about it. You're just building an application on top of it, and it's someone else's code base. And it's easy to start poking holes. Like one of the things that we go when we're talking to an AI company, it's like, what LLM are you using? Like, why that LLM? What if it gets deprecated and you get kicked off? Also, when you look at like code bases, like, is it something that you build proprietary versus like, is it something that you didn't? And I think that's really, really important because, if you're using Google's machine learning algorithm, you're not using your own. There's nothing defensible about it. And especially when you're dealing with AI, there really is a focus about defensibility, because the day that ChatGPT decides to kick off all their users because they're going to charge them, there goes your application. Or let's say they deprecate one of the LLMs and you've written everything specifically for the ChatGPT or OpenAI version 8, and they go to number 10 and then they deprecate it, and you haven't built an abstraction layer to switch them out at any moment in time, you are in trouble. And so as we're doing that, it goes back to the due diligence. It's looking for holes on things in an environment that is literally changing in every week to 2 weeks.
So it's about solving real problems, Adrian. Like it's not like trying to build something and then, hey, let's see if someone gets interested or excited about it, right?
Well,
Now,
it's hard now, especially knowing that anyone can build a ChatGPT application. Anyone. It's like, all right, so you're looking at 10 companies that all look exactly the same. And if they're all saying they do the same use case, then it's like, all right, let's talk about defensibility and who owns patents, who actually has customers paying for them. And that's why I go back to the thing of, it's all about the revenue. Like, who actually is getting paid to build something or actually to like commercialize it.
moreover, Adrian, also like the thing which I think no one can predict it. If one of these providers, like whether it's OpenAI, Google, or Anthropic, or any one of these companies, or now Meta with Llama and so on, because it happened with me. It's not like I have built something, but when AI, I mean, the ChatGPT was still new, so I started to see, this something that's related to podcasting. So you just upload your MP3, and then they will generate for you the transcript. They will generate like options for titles and like show notes and so on. So, and there were, a couple of these startups. I tried even a couple of them, but I expected that why not OpenAI would allow anyone to upload the MP3 file or like even the transcript, which you can do it very easily today, and then I would do it by myself. So I don't need even to have this up. And this is exactly what happened. So the thing is, you don't know, or no one would know, if these companies which are providing the API, funny enough, they're gonna build the application on top of their own technology, and then they will make you obsolete. And guess what? They can tell people, hey, we're gonna give you this for free, right? So part of, for example, of your $20 per month that you pay to OpenAI, I'm gonna give you, for example, something that allows you, I don't know, like to as you said, to do the speeds application. So right, so all what I have built, and because you need to pay the APIs I mean, there is cost. Maybe it's minimal now, but still there is cost. You need to do marketing for your application, and then you end up by having the biggest distribution, which is the providers of the APIs themselves doing it. So it makes you obsolete. So this is why I say you need to differentiate yourself. Now, this is for the AI. What's happening in the cybersecurity space, Adrian?
Yeah.
Just because, to like one small note, to me, is it crowded, or am I feeling it like, again, it's crowded?
It's crowded. There's a lot of identity companies. And interesting in that space, as there's been so much excitement about ChatGPT and AI, and companies are looking to it, they've actually moved their dollars away from identity into generative, because they're like, oh, we should do something in that space. Our product should do something in that space. And so that's a space in the last couple of years has been really crowded. This was a space where people were closing $1 million to $2 million deals. Now they're closing 50 to 100K deals. And so we have one of our companies that was like, all right, if that's the case, instead of closing 3 deals, why don't I close 9 deals? Smaller deals to get my foot in the door. So when things open up again, because they will, we're ready to go. And she's not an identity company, but like when you look at like identity orchestration, identity access management, governance, there's so much noise in that space. And it's really hard because there's people that come from all the same pedigree, but the customer is now looking at, instead of 2 options, they're looking at 20 different companies. And that's the hard thing to distinguish yourself. And I think we're going to see a bigger shakeup in that space because so much money was poured into a certain aspect of cybersecurity that has to do with just identity, which is important, but still now there's just a lot of like, just way too much noise, way too many companies, way too product that's not being bought.
Got you. Let's jump quickly to FinTech, because FinTech is very interesting, very, very interesting. And every time I think, okay, we reach the end, I don't think there's more innovation that can happen, I get wrong.
Yeah.
which I like to get wrong, by the way. It's nothing wrong about it.
We're just getting started.
Right.
And it was funny because a couple of years ago, I was quoted by a magazine here in the US called American Banker. And they said, like, hey, what do you think the future is? I said, the future is going to be decentralized finance. It's the ability for a founder, because if you think about it, like 10 years ago, you couldn't build a fintech. Like there was no way for you to get any banking done. There was no way for you to get money. Right now, you can stand up something that does remittances across companies in minutes. You could stand up, like there's so much kits of parts out there and code bases to move money, which is incredible. And so I was asked by this, I said, hey, what's the future? I said, hey, this is the future. And it's the future because it's the ability for companies to build like financial wallets, to build financial tools as founders quicker than we could ever before. And I said, and because of this, it's going to disrupt some of the traditional players in the space, the MasterCards, the Visas, the credit companies. And it was funny because then someone took Synapse, took my quote and started using it to market it, to be like, oh, and I was like, no, Synapse, you are the guys that are going to be disrupted. And wouldn't you know, like they just shut down like 30 days ago because they got disrupted.
A lot of things happening there. Now, because you invest outside of the US, right, Adrian? Am I correct?
Yeah. So our fund too was invested in Canada. It was invested in the UK. We look at companies in LATAM. We look at companies in Europe. Right now with my current fund, they have to be domiciled in the US, but can do business anywhere in the US. So for me, what I love is to find a company that can, one, makes, most companies I think are domiciled in Delaware, even in the UK, even in, in Mexico or Latino America, but can use a different market. So I was just in Mexico last week and I was talking to FinTechs in Mexico. And when I said one of the powers of what you can do here is you can build a FinTech and you can fail and nobody cares. And then you can stand it up, try again, fail again till you get it right. If you did that in the US, everyone would know you failed. But guess what? If you are able to try something here and then move it to Europe or then move it to the US, move it to Canada, after you've tried and failed with customers in a smaller market, that's something pretty interesting for us to look at because you've been able to kick the tires and now you're going to be ready to scale.
Right. By the way, even here in Dubai and the Middle East, the majority of the companies, what they do is they domicile the company in the US, in Delaware specifically, of course. And then, when they operate here locally, so it's kind of like a holding company that owns, the branches across the globe, which is same case as what you're mentioning about the LATAM and other geographies also as well. Again, it's big because, Delaware has the long history of being, easy to establish a fund and, operate as a VC over there for multiple reasons, I can say. Now, as we are coming close to an end, I want to discuss the impact part of what you're doing, Adrian. And because I know you focus a lot on inclusion, you focus a lot on, in empowering women in tech. And one of the things that also I'm passionate about myself is to empower people to, and this is why I'm liking this conversation today. So to show people that, being in the venture capitalist domain, it's not like you just invest and you wait for companies to exit, because actually you are able to impact people's lives. You are able to empower them to grow economies and so on. So tell me a little bit more about the impact part of what you do at Mendoza Ventures.
Yeah. One of the things I love is the ability that, especially through FinTech, because of decentralized finance, because of sort of this access to products, to be able to touch customers that no one else is touching. And this is where sort of financial inclusion plays a really important thing. So last week in Mexico, I was able to bring one of my founders who focuses on Latino customers, put him in touch with the president of a bank in Mexico. And the first thing he said was, I love this. He's like, no one understands how strong the Latino customer in the US is to the Latino customer here. And he started the conversation. He already had an idea. He was like, I wish we could do this. Will you help build it with us? And it was like instant. Like he had an idea of how to deal with the customers. And he's like, no one's touching this customer. And that's the power of financial inclusion, because most of us on this call are the overbanked. We're being approached by all the banks. Hey, will you open a bank account here? There is a subset of the population that is underbanked. So how do you support the underbanked and then get them to be the overbanked, which is the ideal situation? So I think there is a focus there on the customer, but also on the founder side. For us, it's on the impact side, is finding incredible talent that's overlooked. That, because it's not just whether or not they're Latino or they're a female founder, but also where you are. Everyone thinks, well, the only place you can be a founder is Silicon Valley. There's incredible talent everywhere. There's incredible talent. Like you're in Dubai, there's incredible talent there that want to build something. Like I met some incredible founders last week in Mexico. I was in London before that, but some incredible founders there that are looking to just build things, but also have domain knowledge of their area to be like, here's the problems. Because this is the best founder is the one that finds a problem and understands the problem and is now going to find a solution for them. That's really the ideal and the perfect founder because they know that they're building stuff. And it doesn't matter who they look like, if they or where they are, if they have a solution to a problem and they can build a company, that's an incredible person to find.
Absolutely. I love this because to your point on the talent, like what I can tell, like there's a lot of talents everywhere and they deserve to be exposed to the world. So I love this, Adrian. Adrian, I really enjoyed this conversation with you today. Like time passed, I didn't even feel it. So where people can get in touch?
Reach out to me on LinkedIn. You could follow me on LinkedIn, or just if you want to send me your deck, send me a message, but tailor it to me and say, hey, I heard you on the CTO show with Mehmet. I like you did this. This is what I'm doing.
Okay, that's great. I gotta put the LinkedIn link in the show notes. So Adrian, again, thank you very much. I know how busy can things get, especially for someone like yourself, very active in the startup scene, and you're trying to empower, the founders from investment perspective. And of course, you do more than this with the mentorship and the coaching and all that. So absolutely, really, grateful for you to have, this conversation with me today. And this is how I end my episodes, by the way. So this is for the audience. If you just discovered this podcast by luck, thank you for passing by. If you like it, please subscribe, give us a thumb up, and share it with your friends and colleagues. And if you are one of the people who keeps coming back, thank you for doing so. Send me your suggestions, comments, and everything, that you have in mind, maybe follow-up questions with the guest. I'll try to do my best to get it to them. So please do so. Thank you very much for tuning in, and we'll meet again very soon. Thank you. Bye-bye.
Bye.
Hit that subscribe button, share the show with your tech-savvy friends and fellow entrepreneurs, and leave us a review on your favorite podcast app. Your support means the world to us.